It's a historic day as BloombergQuint launches India's first digital live streaming business news service. Good morning, I'm Menaka, Doshi.
Starting today and over the next few weeks, we will bring you in-depth analytical coverage of markets, economy, business, policy and politics. We sincerely hope you join us on this journey. I'm Niraj Shah.
We kickstart the day with our primetime morning show, IndianOpen. I'm Ira Dugal. These are the headlines. The historic unwind begins. The FOMC says it will start unwinding its $4.5 trillion balance sheet in October. No change in rate trajectory for the year. One more rate hike expected. Equity markets trade mixed post the Fed decision. Some reaction in the currency and bond markets, though, as yields inch higher and the dollar gains. Anil Agarwal will spend another $2 billion to hike its stake in Anglo-American, making him the single largest shareholder in the British mining giant. Matrimony.com will debut on the bourses today. The country's largest online matchmaking service saw decent demand for its IPO, which was subscribed 4 times.
Well, let's take a look at the trade setup for the day. First, bring up the Asian markets, show you what the SGX Nifty is doing as well. It promises to be, or rather points towards a flattish start, maybe a bit of a mild downtick that we will see on open. So the Asian bourses are a bit soft in trade today. And frankly, the market template suggests that as well. Just look at what's happening. Nikkei is an aberration, but look at Hang Seng, look at Shanghai Composite, look at what the SGX is indicating as well. We'll have a muted start. And that's frankly been what's been happening in the markets the last few days. There are gainers and there are losers. The index ends up being flat for most days, but the mid caps and the small caps have a fabulous rally, and that may not really be a different template in today's session either. The DI buying continues. Almost 50,000 crores YTD, which is quite exceptional. It's been a strong domestic liquidity-driven market, as we've been saying, as we'll talk about a bit later on in the show as well. And yeah, we won't have a different start from what the SGX is indicating in all probability. So what to watch today? I think the Bank Nifty expiry today is key for the banking stocks. Remember, while the Nifty and the Sensex are trading at new highs, the Bank Nifty is ceased to do that. It's not really touched record highs, though firmly above 25,000. Dealers expect a range of 24,800 to 25,200 in the session today. It'll be very important to see reaction to the pharma counters as well after the massive rally that we've had in stocks like Dr. Reddy's, Divi's and a few others. So I think that's one pocket you would watch out for. And the subscription numbers to SBI Life will be closely watched as well. A lot of murmuring about whether the valuations in some of these companies, it's a small pocket, but whether the valuations are getting overstretched. I think the subscription numbers to SBI Life could well determine that. It's a large IPO. Do watch out for that over the course of the next few days. But key stocks to watch today, and I think that's the important one. One, while we're talking about the pharma companies, Morgan Stanley has upgraded Dr. Reddy's. It's a big upgrade. The target price has been revised higher to 3133. Do watch out for this one. Could be a very interesting mover in trade today. The Bank of Baroda block deal that happened in closing hours yesterday, remember 3.2% or thereabouts. The stock was active. It's an inter-promote transfer. Don't think it will have a big reaction. In all probability, Bank of Baroda would come off in the session today. Do watch out for that one. NBCC, and guys, the order inflow for this one continues. I think 4,000 crores yesterday or day before, another 3,200 crores today. There could be a further reaction on this one too. And then a bunch of mid caps. We've been talking about these almost every single day. Large deals happen on the upside, on the downside. Yesterday, Royal Orchid corrected 5% after Ashish Kachoria sold. Today, Om Metals could well be a big reactor. I think Equity Intelligence has bought in substantial stake. So let's watch out for some of these mid caps and small caps. Those could be in action today as well.
It promises to be a busy day for the markets. By the way, I just wanted to point out that you can watch us live streaming on BloombergQuint.com, on Facebook, on Twitter, on YouTube, and very soon we'll be on the Bloomberg terminal as well in just a few hours from now. Having said that, every day at this time in the morning, we'll also bring you First Word. That is the editor's pick of top stories that will impact your business day. Well, today on First Word, as the US Federal Reserve gets set to start unwinding its balance sheet, have the markets already factored it in? The Indian markets have only headed higher despite a series of negative triggers, including a slowdown in GDP growth and FII outflows. So what's really fueling the rally? As Anil Agarwal gets set to spend another $2 billion to become the single largest shareholder in Anglo-American, what's Mr. Agarwal betting on, especially as his last attempt to merge the two companies was rebuffed by Anglo. We'll talk about what industry veteran AM Naik had to say to BloombergQuint about the Indian economy and private sector investments in infrastructure. Those are some of the top stories that we will bring to you in the next 30 minutes. Ira, last night was eventful because we saw the Fed do exactly what we had expected the Fed will do.
Historic. I know everyone is saying that the market is factored it in, but that takes away the historic nature of this. The US Federal Reserve is all set to dismantle the biggest experiment in unconventional monetary policy. The central bank will start unwinding its $4.5 trillion balance sheet in October. And if indeed this goes through as smoothly as the markets expected to, many a hat will be tipped in the direction of the Fed. The Fed is also officially on track for one more rate hike this year. Kathleen Hayes, Global Economics and Policy Editor at Bloomberg News, first brings us the key details.
Let's start with what everyone expected, though, and that was Janet Yellen taking this historic step to reduce a $4.5 trillion balance sheet, the first central bank in the world to reduce this crisis-induced extraordinary set of steps. It will start in October. We already knew that. The Fed's going to be letting about $10 billion worth of securities actually run off. The proceeds won't be reinvested. Put that to one side. Very important, but didn't move the markets. It's all about the dots. It's all about inflation at 1.4%, far from the Fed's 2% target. But Janet Yellen, even though she acknowledged it's a bit of a mystery, this weakness, still suggesting the Fed is on track regardless. Let's hear what she said at the press conference after the meeting.
For quite some time, inflation has been running below the committee's 2% longer-run objective. However, we believe this year's shortfall in inflation primarily reflects developments that are largely unrelated to broader economic conditions.
Bottom line, there are now 11 of the 16 on the board of at the FOMC who are seeing the hike in December because they see 3, there's been 2, so that's where we're heading, and a stronger economy in spite of the hurricane. A lot of factors, but definitely the Fed, at least for now, is set in that direction.
All right, it begins from there on. Klaus Bader, head of research for Asia and chief economist for the Asia Pacific region at Societe Generale, is joining us from Hong Kong. Klaus, thanks so much. Really appreciate you taking the time to be with us this morning. Did it go as you expected?
Pleasure.
Not much of a reaction on the equity markets, some upside on the dollar, some inching up of yields, particularly at the shorter end of the US yield curve?
Yes, it went very, very much as we expected. That is, in particular, of course, my U.S. colleagues. And in that sense, the relatively muted reaction in the market is maybe not such a surprise. But, I think we have to make a really clear differentiation between what most economists expect and what the market's actually discounting. And what remains very much the case is that even though the Fed expects to raise interest rates one more time this year, as you said, and 3 times in 2018, the market pricing still is very far removed from that. So, of course, in the past few years, the Fed has overestimated the pace at which they would normalize monetary policy, and the markets were right. But, past performance is no guide to the future. And so I think we haven't seen the last of the market reactions from these Fed moves.
Klaus, I want to focus for a minute on the unwind and as and when it begins in October. Putting your economist hat on, what would be the indicators you would want to watch to see whether there is sort of, some sort of disruption coming through in markets? Do you start with the banking sector, the bond markets? What are you watching closely over the next 3 to 6 months as this process starts?
Well, I think, the level of bond yields, of course, is important. But what I think is far more important is what is going to happen to mortgage rates in the U.S. Mortgage rates have a big impact on personal finances in the U.S. and on the housing market, which is an important part of the economy. So we're going to be watching that very closely. I'd be surprised if in the near term we had a great deal of reaction because the Fed is starting very slowly letting securities that it holds off, and these are mortgage-backed security, MBS security, that it holds on its balance sheet, but it will pick up the pace at which it reduces the holdings of those. And, we don't know, of course, by just how much the Fed is going to reduce its balance sheet. It started out before the crisis at a little bit below $1 trillion. It grew all the way to $4.5 trillion. It's almost certain that when we reach the new equilibrium level, it's going to be quite a lot higher than about $1 trillion, but maybe $1.5 trillion or so. But that is quite a lot of money that the bond market has to absorb. So I think this period of puzzlingly low bond yields is likely to come to an end, although it's probably only going to do so very slowly.
One thing that could keep yields low is perhaps this sort of underperformance on inflation, not the right word to use, but the fact that inflation is coming in still lower than what everybody expects. Janet Yellen called it a mystery, but they don't seem to be too perturbed about it. They don't seem to suggest that reflects some sort of underlying weakness in the economy.
No, and it's definitely true that economists have been scratching their heads hard why inflation hasn't picked up, and more importantly, I think why wage pressures continue to be so low. And I'm certainly not suggesting that I have the answers here to all of those questions, but I do think that there is a real wage argument here. Inflation, of course, through 2015 and to 2016 has been very, very low. And so real wage gains were actually not so bad. And that's true whether you talk about the euro area, whether you talk about the US, but inflation has risen, not quite to the targets. And so I wouldn't be surprised if we did see some increase in wages. But there are many other factors that are likely to put some downward pressure on inflation. In particular, we know that unionization does play a role in the pace of wage growth. And of course, unionization is declining quite a lot. And that's a process that's unlikely to be unwound because the structure of the economies, in particular in the industrialized economies, has changed so much. But if you look at the Fed projections, they do indicate that the Fed believes that the recent soft patch in inflation was just that, a soft patch, and that inflation will actually normalize. They do have the core PCE rate rising over time and then actually meeting their target further out in 2019, 2020. So, actually, the Fed at this stage has confidence that the economy will normalize with it inflation. But we're certainly we're nowhere near an environment where you would expect high inflation. And that's pretty surprising. Remember back when the Fed started the balance sheet expansion, and many other central banks did as well, there were those who really feared hyperinflation. Well, none of that, of course, has happened. But one indicator that central banks are going to have to watch is what happens to credit growth. Because if credit growth really starts to pick up strongly, that would suggest that with a major delay, all that expansion in base money will actually have an impact.
Just a short last word on what all of this means for Asia at this point in time, unless the direction of the dollar changes in a convincing fashion, perhaps not much.
I wouldn't think that it changes a great deal. In the near term, we spoke early on, we spoke about the differences, what the markets are discounting and what the Fed is thinking. And if the market kind of moves towards discounting a higher rate environment, you will see a little bit of strength in the US dollar. But the view from our FX strategist is very much that we've probably seen the best in the dollar and that there are other currencies, maybe with the exception of the yen. And I think it'll take quite a while until high-yielding emerging markets lose their luster. We quite like the Indian rupee, we like the Indonesian rupiah, we like the high-yielding emerging market economies. But that is very much a bond market story. The equity story could be quite different.
Klaus, pleasure speaking to you. Really appreciate you taking the effort to come speak with us this morning here on BloombergQuint.
So we're not really expecting any big shifts today, at least in the money markets, as a result of what happened yesterday, given that we were anyways anticipating that the Fed will do this. They've prepared us for this.
Pretty much, but I continue to say that saying that the markets have factored in sort of takes away the historic nature of this.
No. Look,
September 2008, we were all there.
Yeah, so this is 10 years.
Yes.
It marks 10 years of, technically of that easing process,
Absolutely.
A historic easing process, and the Fed was the first in and now the first out, right? They beat the BOE to it, even though Mark Carney has been saying for the last, 2 years now, that it's time to start moving out. So they beat the BOE to it, and I think that's mostly because of Brexit.
Yeah,
I mean, Carney stayed in because Brexit, could have been the big disruption for the British economy.
Absolutely.
But the Fed, the first one in and the first one out. Now, you just heard Klaus say that he'd be interested in knowing how Indian equities would react to this, because most of what he said was from the debt market point of view. Indian equities have been prepared for what's happening with the Fed for several months now. That's just one factor. In fact, Indian equities have shown quite a bit of resilience over the past month or so. Benchmark indices hitting new highs despite a whole host of negative news triggers, for instance, the GDP story. Niraj is here to tell you what's driving that rally. Niraj, is it just, as they say, exuberance and optimism, or liquidity?
Menaka, we seem to be in a global bull market, but being driven by domestic liquidity. That's really the irony, right? You typically expect global liquidity to be the case. But here's what I've done, a small analysis since August 11th and probably over the last 1 month and the last few days of what the benchmark indices have done vis-a-vis what the mid caps and the small caps have done. And therefore the question whether we are stretched on certain indices, if you will. So the 5-day return, the 1-month return, and since August 11. Why August 11? Because that's the day from where we started the bounce back from that 97,100 level. Now look at what a benchmark has done, which is the Nifty, and then compare that to what the mid caps and the small caps have done. You could argue that the 5-day rally, such differences happen. But since August 11th, when the market started rallying, the Nifty's gained 4.5%. The key is the mid caps and the small caps have almost gained double digits. And the valuations are not looking cheap. You may argue that 23, 24 times for the Nifty trailing basis is probably still okay. But look at what the markets have digested as well since August 11th. Now, while we're calling these concerns, but the key is I'm saying this is what the market battled with since August 11th. The slowdown in GDP growth numbers, 6 straight quarters, I think I heard Ira say sometime, but 5.7%, which is substantially low. Rising geopolitical tension, North Korea, US battling out, and still we are trading at new highs. Since August 11, there have been 2 instances wherein such things have happened. Net FII outflow of over 15,000 crores. This is again since August 11th, from where we started off. FIIs have actually pulled out close to 15,000 crore rupees from the Indian markets. That's the third big concern. The markets have battled the assumptions of when the growth recovery come in. We've seen enough and more economists and sell-side brokerages saying that growth will bounce back in quarter 3 and quarter 4. An equal number of people saying that even FY19 seems to be a washout here. Battling all of this, the markets have come back to new highs. And look at this one chart. This is the chart of the trailing price equity for the Nifty. It is trading at 7-year highs. It's the highest price earning multiple on the trailing basis since Jan 2010. So it's actually an 8-year high. We are trading at substantially high levels, not just for the Nifty, for the mid-cap index as well. The mid-cap trailing price equity multiple is 40% higher than the previous high that the mid-cap index clocked in, I think some 12 years back. So that's the amazing thing about how the market is trading at the valuations, market cap to GDP 5-year highs. So all these multiples point towards an imminent correction. Why is that not happening? Well, simply put, as I said, we are a domestic liquidity driven rally in a global bull market. The only question, guys, and I just leave it with this question, I don't have an answer to this, but what happens if the markets, global markets were to correct? Will the domestic liquidity, not just the mutual fund liquidity, but the PMS liquidity as well, which is a large part, will that come to a pause, and will that trigger a further sell-off if it did were to come to a pause? That's a question which I don't think anybody has an answer to. Everybody will try and give thesis, but I think we'll know that it's happening only when it happens.
You know, this argument about sort of peak valuations, especially in the mid-cap, small-cap space, is something we've been discussing internally as well for several weeks now. And it just seems that every time we discuss it and every time we talk about will this foster some sort of weakness in the market in the ongoing rally, you just get hit by another gush of liquidity, right? Yeah. Domestic liquidity, as you pointed out. So unclear to know when or how this rolling stone will stop in some fashion.
No answers. As I said, we'll get to know that it's happening only when it happens. Until then, maybe ride the party.
All right, fine. That's what the markets look like. Now, the other big story that's playing out globally and has a very big India angle to it has to do with mining billionaire Anil Agarwal, the founder of the Vedanta Group. He's looking to increase his stake in Anglo-American PLC. The Vedanta chairman may buy about 9% in the British miner for about $2 billion. Let's take you through some of the key elements of what's going on there with Anil Agarwal and Anglo-American. So he's going to spend, like I said, $2 billion. This is going to be through mandatory exchangeable bonds, which will be due in 2020 and eventually will result in about a 9% stake in Anglo. That's in addition to the 12.43% stake that he's already bought since March this year, and that 12.43% was also bought through these mandatory exchangeable bonds. What is he looking for, or what will he get in Anglo-American? Copper mines in Chile, iron ore operations in Brazil and South Africa, and diamond producer De Beers. Anglo-American is amongst the top 5 mining groups in the world, so that's a really important company. And commodities have been having a tough time over the last several years, but it does look like this will be the year of recovery for commodities. Anil Agarwal there making a very big bet on Anglo-American. Now, we should point out here that he did, or rather Vedanta did make a merger offer last year, and that merger offer was rebuffed by Anglo American. This year in March, when he made the initial stake purchase through exchangeable bonds in Anglo American, and he's doing this through a private investment company, he said he was not interested in a takeover at this point in time. It's something that he has reiterated yesterday when news was released that he was buying this additional, sort of 9% stake, so to speak. So he's saying he does not intend to make a takeover offer for Anglo American. And the way it works in UK's takeover rules is once you say that, for 5 months you actually cannot launch any takeover offer. So it's interesting. He's saying no takeover offer, but you don't just take a stake up to 20% just like that, right? I mean, 20% sort of 10% would make you a financial investor, 20% would bring you very close to a strategic investor. And like I said, he's tried before to merge the two companies and it hasn't worked. So maybe there's some hope alive somewhere in Mr. Agarwal. Maybe he's just excited about the diamond business. He's spoken about that before as well. And, to be able to add to India's dominance, at least in the diamond processing trade. He wants to mine diamonds here. And you'll also see on your screen a chart that points out the key contributing metal revenue for Vedanta versus the key contributing metal revenue for Anglo American. So Vedanta, you have copper at top position, a bunch of other metals, aluminum coming in at about 20%, oil and gas, and that's cane, power, and iron ore, which is a very small contributor. At Anglo American, you've got metals and mining, which is 36%, diamond, which is 27%, iron and steel about 21%, and then thermal coal and phosphates. Big story there. Like Niraj said about the markets, I can say the same thing about about Anglo American and Anil Agarwal. Don't know which way this is going to go, but you don't buy 20% just for nothing.
And the two seem to have, if you put the two components, revenue components together, there isn't a huge overlap. So there is some sort of, complementarity, hypothetically.
But in merger arguments, if you're arguing, I mean, that can work for or against, right?
Yes.
I mean, you might look for complementarities, or you might look for, in this case, diversifying or expanding your metals portfolio. So it could be both ways. But the point is that if he does manage to do this, he gets propelled into being one of the top 5 metal companies, and that for Mr. Agarwal's ambition is always a good thing, isn't it? So big story to watch out, especially as metals recover this year. I think that's been another trend we've been watching very closely, and if nothing else, his investment is going to pay off richly for him if that rally continues over the next several months. So
if this is the turn of the cycle. Actually, we'll stay with Europe and we'll stay with the broader metal space. Tata Steel and ThyssenKrupp plan to merge their operations. This is a story that played out all through yesterday. The 50-50 joint venture will see both companies transfer their assets and, more importantly, in Tata Steel's case, some of their liabilities to the merged entities. So how much of the debt will actually get transferred? What does this mean for the overall Tata Steel balance sheet? Darshan Mehta standing by with the calculations. Darshan.
Ira, yesterday in the press conference, a lot of numbers, big numbers was used, $2.5 billion. Let's just simplify it and make, sense of what it means for Tata Steel. Now, if you're looking at how the numbers pan up in trade, the entire debt, that's the total debt of net debt on Tata Steel book is close to 74,000 crores. The India business, this is the India business debt, is close to 40,000 crores. 17,000 crores is something that has been transferred to ThyssenKrupp JV. And finally, the balance 17,000 crores is something that will be restructured. How will this be restructured? It will be done mainly from the dividends that it will get because of the JV that will come in, because it's a profitable JV, it's making money. Now, 35% of the debt will be transferred of Tata Steel Europe. So that was close to 17,000 crores. The residual debt will be restructured. That is something that they have said in the press conference, and that will be done because of the dividends that we'll get. It will be done from using the dividend payout from the new joint venture. And now the India business becomes separate. The 40,000 crore that will be there as far as the India business is concerned, that they will be standalone. They will be actually the India operations will be used to service this entire 40,000 crore debt. So that's how the entire plan works as far as the debt part of Tata Steel joint venture is concerned.
What do brokerages have to say about the deal?
I think across the board, they have actually been very, very bullish. Now look at the brokerage targets. CLSA, Credit Suisse, Axis Capital, IDFC, Deutsche Bank, all of them have raised the target price. CLSA has actually raised the target price to 850. The earlier was 800. They say that they expect the deal to be EPS accretive from day one itself. Credit Suisse is saying that, the merger ratio and the entire deal that had happened is much better than what they had anticipated. HSBC is saying that the consolidation of the European steel industry is extremely positive and that will give them pricing power. Axis Capital is now saying that, they have a target price of 765. They've also raised it. They're saying they will be able to now focus more on the Indian operation and look at expansion of their Orissa operations. There are a couple of them who are not very, very impressed at this point of time. One of them being Jefferies. Jefferies has a target price of 424, which is much lower. And Macquarie also has an underperform with a target price of 694. The reason that Jefferies says is the fact that they believe that this entire deal and the potential benefits is already priced into this entire stock price. So they are underperformed. Macquarie has actually raised the target price, but yet they stay underperform on the counter. They are saying that now the focus will shift on the Indian operations and they can flex their muscles now and get the India operation back on shape. But overall the consensus is it's a good deal. They've raised their target price and now the focus will shift on the Indian operations. Management can focus on it and the joint venture will take care of it.
They've lost leadership, right, in the Indian operations. JSW Steel has overtaken them, and that's really a sad story because I remember from the times that those of us who covered JJ Irani would have told you how he used to so proudly talk about how Tata Steel was the leading steel manufacturer in this country and at the best efficiency parameters when it came to everything from production efficiency to working capital efficiency. So it does look like a big climb back for them. Darshan, thanks very much for that. As we wrap up First Word, a quick sort of reminder to our viewers that today on this show, later on, we'll also be bringing you an interview with A.M. Nayak of L&T. Now, Mr. Nayak retires as Group Executive Chairman at L&T at the end of this month, and he will continue at L&T as Group Chairman. So it's the executive responsibilities that he's given up. He sat down with me for an hour-long interview to talk about his 55 odd years, which he actually refers to as 106 human years in L&T, given the number of hours that he has worked in that company and the time that he started as an engineer, and a very moving story about how he didn't know how to speak English. He made some 7 or 9 errors on his application form at L&T, and then he spent months training himself in English. He was not from IIT, so he was at a disadvantage, but he finally made it to L&T, which was a dream of his. He always wanted to work there, apparently, and then worked really very hard. And of course, then we know the rest is history, as they say. The key takeaways from Mr. Nayak's interview are these, 2 important ones. One, that he does not expect the economy to show any dramatic recovery for at least 9 months. So he said it this way. He said, I expect it to stay stagnant or steady state for at least the next 9 months. And he should know because he talks to businesses small and big across the country. He deals with state governments. He deals with the central government. So that's his view on the economy. And, I asked him whether he saw private sector return to infrastructure in, the next few quarters. And he said, I don't think that'll happen for at least 2 years. Now, interestingly, in February when I spoke to him and I asked him and he said, I don't think that'll happen for at least 2 years. So I asked him again this time, saying, you said February 2 years. He said, I maintain 2 years. So 2 years from now is when he expects any kind of private sector return to infrastructure. But for more on A.M. Nayak, come back and make sure that you watch that interview towards the end of this show.
Also at 9:45, we talk about the private insurance industry with Arijit Basu of SBI Life. Their IPO is in the market. And at 9:55, Flippo Gauri tells us what JP Morgan is betting on.
Well, that's a wrap on First Word, but let's also take a look at what the derivative space is indicating. Full tilt towards trade and markets. Agam Vakil is standing by with their setup. Agam, good morning.
Good morning. Well, the sideways move for benchmark indices continues with flat moves for the Nifty. And in terms of the way the futures have panned out, there's very little move in the spot price. But there has been a near 2% increase as far as open interest is concerned in the September futures. When it comes to the Nifty Bank as well, very little move on the index itself, but a near 4% decline in open interest. So unwinding seen in the Bank Nifty. That said, 2 particular variables I'm keeping an eye on. First one, of course, is the Nifty put-call ratio. That has remained about the mark of 1.57. And ordinarily, whenever the Nifty put-call ratio is above that mark, it follows a little bit of weakness. That said, when it comes to India Volatility Index, that has moved up, but it is still below the mark of 12. And a lot of analysts are of the opinion that should this continue, we could see an increase in volatility going into the next couple of days. Moving on, in terms of the most active options yesterday, I wanted to bring into focus two options, and those were the 10,200 call and the 10,200 puts. And that is where we've seen unwinding in both these options. So we are looking at a lot of consolidation around that mark. And in terms of stock futures, we are keeping an eye on South Indian Bank, Nalco and Hindalco. Of course, there has been a lot of change in terms of your F&O ban, and we do have the likes of India Cement and Indocount moving in, so we'll be keeping an eye on those counters as well.
Thanks a lot for that, Agam. Abhijit Pathak, Director at Define Edge Solutions, joins us right now on the show with the F&O perspective. Abhijit, good morning. Thanks for joining in. Is there an index strategy that you have, either a future strategy or a combination of futures and options, Abhijit?
Yeah, right now in the bank Nifty, it is more sideways than Nifty. So it is better to short the 25,000 monthly straddle, the 25,000 call and the 25,000 put. And going long on Nifty on dip when the 10,200 call comes to around 25 or 30.
Fair call. Abhijit, there has been a flurry of activity in pharma names. Anything that has caught your eye? Anything that is good enough for a trade this morning?
No, actually, Dr. Reddy's was quite bullish yesterday, but I think there will be some selling pressure today in it if it opens gap up.
Okay, Abhijit, there is also a fundamental call. Morgan Stanley has raised the target price, and therefore there is a likelihood that Dr. Reddy's might start off higher. At what levels would you look to go short, if at all?
Yeah, actually, that 24,000 call is the main resistance. So as long as the 24,000 call remains below or around yesterday's high, that is the level I am looking at. If that doesn't cross yesterday's high decisively, that is the level where Dr. Reddy can be, you can think of going short in Dr. Reddy.
Fair call. Abhijit, before we let you go, your stock recommendations for the day today.
Yeah, I think State Bank of India has been sold off quite a bit, and it is approaching a very big support area of 260, 265. So it can be bought near 265, 267 futures rate with a stop loss of maybe 262. And this can be an intraday as well as a positional trade.
Okay, Abhijit, thanks so much for joining us this morning and giving us your strategies. So that's some futures and option strategies that people can work with. But it's now time to shift focus to all forms of trade. And let's start off with the commodity pocket. Pradeep Pandya joins in this morning on Indian Open with a quick sense of what's happening in the commodity space as well. And Pradeep, suffice to say, while crude saw a bit of a downtick, and that may well be in focus, what about the other commodities? What is it that is top of your mind?
So it's risk on everywhere if you look at it. And to begin with, if you look at gold, which has finally broken the $1,300 mark. So if gold is weak, which means people are willing to take risk, they are actually buying into other commodities. Like if you look at aluminium, you look at zinc, both have opened strong. If you look at other metal, for example, there could be some weakness here and there, but rubber is also bouncing back after a significant decline. But gold is, I think, most important, and also crude. So we'll focus on that. Gold has slipped below $1,300. It's a 3-week low on gold, which means the risk appetite coming back. And you look at crude, that actually surprises. Yesterday also we had alerted that crude is looking very strong, and we are all set to break above the hurdle of $50 on WTI and $55 on Brent. It's actually happening. But what is more surprising, the data that came out yesterday from EIA, you look at it, 4.6 million barrel added to the inventory. Now this is higher than what was expected. The expectation was only 3.5. Had it happened in usual course, you would have seen crude correcting by $1 or so. But if you look at it, it actually closed strong. So all eyes are actually on Friday's meeting of OPEC and non-OPEC countries. And if there is, further discussion, extension of the cuts or deepening of the cuts, as Iraq has been talking about, that would be really interesting. And ICE sugar, that is yet another point I think we should keep in mind. Sugar stocks should look strong with 2.5% gain in sugar prices globally.
So that's interesting, but they did correct, I think, the day before or something like that. So let's watch out for those as well. I was just thinking, Pradeep, just before we get in our research team and talk about all the key stocks to monitor this morning, it'll be very, very interesting to see what's happening to Bank of Baroda today. Yesterday, we were talking about it in the dying hours of trade. There's a large block deal that happened. Now we know that it's not really a large fund which is bought into it. Let's figure out if there is some bit of correction that could come in today, because that deal took Bank of Baroda higher, but took a lot of other PSU banking stocks higher, because in the last 30-45 minutes, we saw a quick bump up in a bunch of these PSU banking stocks. Let's see if there's a bit of a correction there, but that's another monitorable, quite frankly, in the session today.
So why it would be important? Because the Bank Nifty has been kind of lagging the Nifty. Usually we see Bank Nifty hitting a new high and Nifty then follows, but this time the trend is other way around. So if PSUs actually start firming up, they'll probably drive Bank Nifty up. Will it happen? I think you have doubts about it.
No, let's see. It's the Bank Nifty expiry this week, today as well. So important day of trade. But let's talk about all of that with Sanjeev Bhasin. He's Executive Vice President of Markets and Corporate Affairs at IIFL, joins us right now on the show. Sanjeev, good morning. Thanks so much for joining us here on BloombergQuint. What's your sense, Sanjeev? Are you as skeptical as some of the others on the near-term market scenario?
Yeah, hi, good morning. Yes, Niraj, I am also in the camp which thinks that the market is overbought, overpriced and over-optimistic. And I think a correction, I've been calling for it from the last 2 months, is actually just not coming. But definitely, this is the time to be extra cautious as we see the 10-year US bond yield hit near 2.3 levels, which is good for banks in Europe and America. But it could be hurtful for that means that the cost of money is definitely on the rise, and bonds are now again going to be, a parallel asset class where there will be money flowing.
So, Mr. Bhasin, if you look at it, FIIs have been selling in Indian equities. What happens next?
Yeah, so it's a wall of liquidity which is driving markets higher and valuations really to the top of the much above most trading ranges. However, in the end always macros and equilibrium will come back. So this is a globally liquidity driven rally where all walls of worries have been climbed. But in the Indian context, we are missing out on 3-4 things: poor macros, oil price, which is again going to be a negative for the government, and thirdly, earnings not being totally misplaced. Along with that, if you add then private consumption or capex has just not taken off. So sum of parts, I think we are very, very extremely fairly valued, and I wouldn't rule out a 5% correction in the next 45 days from here till end of October.
Sanjeev, one quick word on pharma as well. They've seen a massive rally, the likes of Divi's, Dr. Reddy's, etc. There is a big upgrade that has come in on Dr. Reddy's individually today. But what's your stance on pharma? And are there any specific stocks in the pharma pocket that you're looking at?
Yeah, so Niraj, actually we've been slightly contrarian, and in the last 3 months we had put out a very big buy as a SIP in 5 of the large cap pharma names, which included the likes of Dr. Reddy, Lupin, Sun, Aurobindo and Divi's Lab. And we still think that SIP should continue with actually a 30% upside. And we are very, very positive that pharma in the next year should be the poster boy of sectors, and you could see at least a 25% upside, given that generic pricing, FDA approvals and contract facility, all that is getting resolved. So for us, like you mentioned, Dr. Reddy has been a very, very big outperformer from the recent lows. We think you could actually be surprised on the upside on the case of Dr. Reddy. We think Sun Pharma, on the back that everything is now tinging around halol, and that we think is a very, very big possibility that in the next 2 months you get a possible clearance on that. And Lupin, where R&D cut would mean improvement in return on equity, and the pipeline which they have would be the strongest amongst the large caps.
Okay, Sanjeev, stay on. Lots more to talk about. Let's get in our research team now to talk about all the key stocks and news, the newsmakers of the session today, a couple of new listings, what our brokerage is saying. I think there was an analyst meet, and it'll be interesting to see what the key takeaways of that one are as well. So, wow, it's a full house today. Shraddha, Somit, Darshan, Nikki and Agam. Good morning, all of you guys. Okay, ladies first. Let's start with you, Shraddha.
A couple of stocks and news that we are tracking, starting with Granules India, where the QIP opened yesterday. Now the float price has been set at 127.63. That's a near 3% discount to yesterday's closing price. Also NBCC, where there has been multiple news flows around that company. The latest one being that it has won a 3,200 crore worth project from the Union Finance Ministry. That will be to develop a residential office complex in Mumbai. We're also tracking Novartis India, where the company has said that that the board will meet on 25th September to consider a buyback proposal. Remember, the last time around they had done a buyback was in September 2016, so last year itself. Another interesting listing, Lasa Super Generics, which is the demerged entity of Omkar Specialty Chemicals, will list today. And also two interesting bulk deals that we are tracking. One being O Metal Infra Projects, where investor Porinju Veliat's investment arms, that is Equity Intelligence and EQ India Fund together, have bought 1.4% stake. The stock already rallied about 12% yesterday, but in all possibility, we will see it inch up further. And lastly, Bank of Baroda, where Thelim Master Fund sold its entire 3.3% stake in the PSU lender that was bought by Merrill Lynch Market Singapore. So all of that will be on the radar.
Thanks a lot for that, Shraddha. Watch out. Home Metals could be an interesting one, but Shraddha is right. There's a bit of a rally that has happened in that stock already. A couple of new listings, new kids on the block. Samit, let's start off with Matrimony.
So Matrimony's issue was subscribed around 4.4 times, with most of the demand coming in from retail portion. Now, retail portion was subscribed 18 times, while the QIB portion was subscribed 1.9 times. Now, Street is expecting a premium of 80 rupees per share. Now that is what 8% listing gain on the issue price of 985. Now, when you come to the valuation side, the share price of 1,050, the market cap would stand around 2,400 crore, while the price to earnings ratio would be around 40.6 times. And at a share price of 1,100 crore, the market cap cap could be 2,500 crore, and the price to earnings would be 42.5. Now, financially, if you see, Matrimony's revenue grew at a slower pace when compared to Jeevan Sathi. Over FY13 to FY17, the revenue grew at a compounded annual growth rate of 11.6%, while that of Jeevan Sathi was at 16%. Now, this data finally shows that Matrimony is the leader, and bachelors spend more time on their website. Now, Matrimony had a unique visitors of more than 9,90,000 for the month of June, which is double of what Shaadi.com had.
You are a bachelor, Samit?
Yeah.
Do you spend time there?
No, not at all.
You don't spend time there. Okay, fair call. Well, that's a disclaimer from Samit, but yeah, do watch out for Matrimony list today, as does Dishman.
Yeah, so Dishman, it got delisted in May 29th. The price was 300. Now, what had happened in the meantime was a reverse merger with its Swiss subsidiary Carbogen. So that is something, because of that corporate action, it was delisted. Now it is again relisting today, so the base price will be 301 for Dishman. What does this do? Mainly, why was this entire exercise done? Firstly, they will get a lot of tax benefits to the tune of almost 300 crores because of amortization of goodwill as far as the Swift subsidiary was concerned. And secondly, they're looking to increase their net worth because of this entire exercise. Their net worth will increase. But financially, nothing changes because Carbogen was anyway consolidated as a subsidiary in Dishman Pharma. Just one view that has come out, that is HDFC Securities wrote a note about it. They believe that the target price could be 405 rupees, which means a potential of 35% upside. They are valuing it at 20 times FY19 EPS. And they're saying that they expect the EBITDA, net debt to EBITDA level from the earlier over 2 times to currently go to close to 1 time by FY20. So HDFC Security seems to be rather bullish on Dishman. It will list at 10 o'clock, so we'll talk about it that time again.
Great. Thanks a lot for that, Darshan. Analyst meet takeaways, Nikki. Good morning.
Hi, good morning. So Bharat Electronics management takeaways are, I'm just going to quickly summarize in 5 points. The management has guided a 16% revenue growth over the 1 year and double-digit order inflow growth. Order inflow is expected to sustain. The amount of 15,000 crore is expected to sustain over the next 3 years. It has forayed into 2 new business that it mentioned in FY17. It's going to explore the opportunities to export military equipments, for which it has already submitted a proposal for, and it is expected to incur in capex of around 2,500 crore in a span of next 3 to 4 years. What IDFC Security has to say about this? Well, it is maintain an outperform rating for the company with a target price of rupees 220 per share. 3 points there. They're mentioning that the company is well positioned to capture the growing defense spend. It expects the margin to dip by as much as 175 basis point to 18.8% in a span of next 3 years. However, it expects the EBITDA to grow by CAGR of 14% in a span of next 3 years. Jefferies also pretty much has a positive view on the company. It says that it has a visible order inflow pipeline of rupees 130 to 150 billion over the next 5 years. It expects some additional order inflow of around 1,300 billion from sizable projects, and the company's new initiatives are expected to meaningfully contribute only post 3 to 5 years.
Okay, thanks a lot for that, Nikki. and some other brokerages as well, 2 or 3 other stocks which brokerage notes have come out with today.
Right, Niraj. We do have an up move on Devi's Lab yesterday. So Axis Capital almost doubling its price target with an upgrade to buy. This is, of course, after the US FDA re-inspection, and they expect their FY19 revenues, EPS estimates to increase by as much as 15%. Moving on to Macquarie on United Spirits, they maintain an underperform, but they also increase the price target to 1933, and this is on account of expectations from increase in Telangana. So they are, factoring in a 10% price hike to boost EBITDA margins, which could be up by as much as 50 to 60 basis points. And finally, coming down to IDFC Securities on Z Entertainment, they maintain an outperform with a price target of 570, and this is largely on account of a strong business model and disciplined content investments. And because of that, they expect an increase of 15 to 16% in ad and subscription revenues, or CAGR, over FY17, FY19. So good view coming in as far as Z Entertainment is concerned from IDFC Securities.
Thanks a lot, all of you, for joining us and giving us those perspectives. Sanjeev, one quick word. Out of so many stocks in focus, I thought NBCC was a key one. Received a large order yesterday or day before, another 3,200 crores order received as well. It's a stock that, the order book keeps on going up further. What is your view out here on NBCC?
Well, Niraj, as a disclosure, from the last 3 years, I've been tracking and recommending NBCC when it was just a market cap of 3,000 crore. And today you have it close to 19,000 crore. And if anybody is looking for another 3-year idea, then I can tell you the market cap will be 30,000 plus. Given that it is the best quasi play on construction in tier 1, tier 2, like you said, the order book, the management sounds confident that by 2020 the order book could be in excess of 1,20,000 crore. They have a unique model of no debt, and how they are 25% they capitalize in the PPP partnership. So it's a no-brainer to buy this stock on any decline. It's one of the best PSU plays, and we think that we are relatively overweight, but only on corrections. The other two you just named, Bharat Electronics, which has been one of our topics from 100 level or 1000 when it was 10 rupee paid up. Given that I think defense spending in this budget will be a record, and that itself will tell you how this well-managed company can be a beneficiary of huge order inflows. Plus their capex, which they suggested last year on a lighter note from 7% has now gone up to 10%, and the order book is growing at 12 to 14%. Another one which I would name would be Engineers India as a best proxy on expansion in the hydrocarbon space on all the oil marketing companies, which would again get an inherent share of the Lion's business going forward.
Okay. So these are the stocks to watch out for. Now we are joined by Sahil Kapoor, Chief Market Strategist at Edelweiss Financial Services, and also Gaurav Bissa, Derivatives Analyst at LKP Securities, joining us in the studio. Gaurav, now that we have kind of seen a breakout, but market is consolidating, if you look at Nifty, what is the strategy really at this point of time?
Good morning. Yes, we have seen a breakout. 10,000 call option commanded the highest concentration for 2 series in a row. Now we are trading above those levels. If you look at the option chain, 10,000 put now commands the highest concentration, and some sort of selling is seen at 10,200 call options. So I don't think there will be too much of pressure coming in the markets. We may consolidate for another couple of trading sessions, but overall the momentum, the trend is quite strong, and we can head towards 10,220, 10,240. So at this point, I would recommend buying with a stop loss of 10,100 to 10,110 and play for 100 rupee upside from the current levels.
Sahil, what about you? Is there a strategy in the Nifty or the Bank Nifty? It's the Bank Nifty expiry as well today.
Yes. So I think Bank Nifty more or less is trying to consolidate around 25,000 levels. What is exciting for us is 28th September, 25,000 put. That I think closed at 167 yesterday. So if you get around 180, 190 levels, I think it could be an interesting trade, because IV is at 11, 12 on the index, and for Bank Nifty around 15, 16. I don't think there is going to be a 200 point slip up anytime soon, and you have a theta of about 12 to 15 points. So I think it will make sense if you go short on that put option at 190 or so. From a 28th September expiry perspective, I think there is going to be a breakout in Bank Nifty as well. For now, I think for the next 1 or 2 sessions, it is going to consolidate.
Okay, so let's talk about individual ideas as well, gentlemen, that you've given. Gaurav, let's start off with your first idea for the day. Not surprised, NBCC.
Well, yes,
but it'll open up higher, Gaurav. Would you still go out and take up bet there?
If it opens on 220 to 23, I would still be a buyer. It's seen strong momentum, it's seen strong long positions getting built. And if you look at option chain, 220 call option commanded very high concentration for 2 to 3 series in a row. And if it sustains 220, I would not be surprised at 230 to 35 kind of targets coming in. So if it opens around 223, 24, I would revise my stop loss to 218 and play for 232, 234 kind of targets. If it opens with a mild upside of 220 to 21, have a stop loss of 215, play for 230 kind of level. So I think it has a strong momentum ahead, and I would be a buyer between 220 to 224.
Okay. Also, if you look at another stock to watch out for today, should be ITDC. We saw a bump up yesterday when the news came in that they are planning to disinvest 3 properties, and probably one deal has already been finalized. That's the kind of indication we have. Sahil, have you had a look at the chart? Any views?
Yes, I think the momentum and the volume numbers clearly tells you that there is a trend which is developing here and which is already gaining momentum. So I think there is a good possibility you will head towards level of 610, 615 over a period of time. So it continues to be a good long position. I think you should maintain long positions in ITDC.
Okay, but some strategies. Sahil, you have a strategy on Parag Milk. After a while, I'm seeing somebody give a strategy on Parag Milk. Why this one?
Yes, I think there is a big base formation already in place. The stock has already spent a lot of time between 200 and 250. It's trying to break out. There is a gap at 264. I think that there is going to be a good strong breakout above that. So it is more of a preemptive play. I think the risk reward now favors the long side. So I expect it to move towards 285 to 290, and stop loss should be below 224. So that appears to be the strategy. It's a laggard, but I think there is going to be a breakout in that.
And Gaurav, you're looking at Federal Bank.
Well, after a long consolidation between 105 to 120, the stock is now coming out of consolidation. If you look at the open rush versus price pattern, you will see a lot of writing in call option was seen at 120, 125 levels. A lot of selling was seen in terms of open interest additions around 120 levels, and it is to see reversals towards 110 levels. So this is the first time we are seeing a consistent move above 120. If it sustains these levels, then a quick move towards 130, 135 cannot be ruled out. So with a stop loss of 116, one can buy a 125 put option, a call option. That can also be a good strategy. So I think in this month, among the mid-cap banks, Federal Bank can be one of the best performer.
Okay, stay on, gentlemen. So much more to talk about. But time for the Bloomberg Edge for the day with Jayesh Khilnani. Dr. Reddy's has not been in the best of health this year, falling more than 25%. The last few days have been good. There is a brokerage note as well today. But what is more important is that the Bloomberg terminal is giving us an insight into what could Dr. Reddy's do today. Jayesh, what does the greed and fear indicator have to say about Reddy's?
Morning, Niraj. So it's indicating a buy signal as of yesterday's close. Now, first, let's have a look at how the fear and greed actually works. It's a proprietary Bloomberg indicator which oscillates on the zero baseline, and it uses average true range and true range as a concept behind the calculation. It helps you to generate a buy and a sell signal. Simply follow the color to get those signals. Green color indicates buy and red color indicates sell. So let's come back to the chart of Dr. Reddy's that we have. As of yesterday's close, we can see the bottom panel, that's the fear and greed, and it oscillates on the zero baseline. As of yesterday's close, this has actually changed color from red to green, thereby suggesting that a buy signal is in place. Also remember that the stock is still down about 24-25% in the year so far. So, even a technical pullback can take it to higher levels.
Jayesh, just quick question. What's the efficacy of this indicator for Dr. Reddy's?
Yes, Niraj. So what I did was, a little back testing. The previous two instances, let's assume the buy signal and the sell signal that was generated. This buy signal in the month of June, it lasted up to July, and it gave you a return of about 3% on the stock on the upside. The other way around, when the sell signal was generated, from this period till yesterday, the stock is nearly down 15%. So safe to assume that this is a good indicator to follow as far as Dr. Reddy's is concerned.
Okay, so that's the call on Dr. Reddy so far as our proprietary indicator is concerned. But Sahil, have you been watching? What's your view?
Yeah, so generally we do not subscribe to buying laggards. We generally avoid them. But I think there is a gap at about 25-20 for Dr. Reddy's. And this being a news motivated uptake, and plus there is volume and open interest, I think there is a good possibility that it will go and fill that gap. So you could see a short-term bump and take it as a trade and let the gap get filled, and you should exit before it gets filled. So I think it's a short-term buy trade.
Okay. More on technicals in a bit. Let's focus on the other key newsmakers as well. And Sanjeev, today amongst the brokerage notes, I think the one that is interesting is United Spirits. Macquarie sees tough days ahead. They maintained an underperform while the target price has been hiked ever so slightly to 1933. We haven't talked about this liquor space for a while. Is there merit in either moving off from the holdings that you may have in the liquor companies, or maybe initiating and starting to invest in any of the liquor companies?
Well, it's a glass half full or half empty. If you actually wanted to play the consumption side, then you got a very good risk reward closer to that 1850, 1900. I know of very large brokerage houses which are downgraded United Spirits. But the management has been very robust in the last 2 quarters. Earnings have caught up, the new portfolio, the new branding, and the new franchise network which they have. Yes, the overhang of prohibition remains, but I think that is far-fetched. Alcohol spending and alcohol consumptions are on the rise. We think Diageo is best placed to gain over a period of time. Any correction would be for us an opportunity to buy. We think the stock in the next 3 years can easily be a doubler from here and is one of the best plays on the consumption side on rising incomes both in the middle class and in the wealthy side. So for us, this is a very, very good long-term play. Notwithstanding that the rhetoric will deter most people and lower down expectations going forward.
Okay, and Mr. Bhasin, what's your view on matrimony? What kind of listing do you expect, given the fact that it was actually the retail segment that went overboard on this, and overall subscription was only 4 to 5 times, while retail was subscribed roughly 18 times?
Well, right now there is a flurry for stocks, and irrespective of valuations or price, it's being chased by everyone on the retail side. So brokerages are having the best time of their life. Only thing is that I don't know if valuations are supportive of further, you'll get an initial pop. I would recommend actually to sell into any rally. For us, if you want to be in this space, then Info Edge or Naukri is a very, very good play on the rising pattern of where they have a stake, I think, in one of the matrimonial sites also, and that is doing exceedingly well. So I'm not saying that this is not a deterrent, but the price performance may be overstretched for this particular IPO.
That's interesting. Let's wait and watch what the listing is today and then take a call. The management, of course, will join us post-listing as well. So that's the other interesting one. Remember, two listing, one relisting, one new listing. So watch out for both of those. Sanjeev, I'm looking at the stock recommendations that you have. We've discussed a couple. What I think we haven't discussed is Godrej Properties. Now, one, why real estate? The stocks have given a bit of a rally, but there's nothing substantial out there. I mean, the pickup in sales hasn't happened. So why real estate in the first place, and why Godrej Properties within that?
Yeah, so as a disclosure, Godrej Property has been under my coverage from 290 levels. It's more than doubled, but we still think that the best possible play on the real estate market and the execution and pedigree management of Godrej continues to be Godrej Properties. The only laggard that is on a quarter to quarter to track the execution may be slightly misplaced. But if you are looking for 2018 and beyond, then I think reality should come back with a huge positive, given that wealth effect, positive consumption spending, and the recent cut in rates has actually started to see a lot of inquiries on the first user base. So Godrej Properties for us is a no-brainer. It's a pedigree management. They don't buy and hold. They take on lease, execute. So there is no problem of land bank holding, and execution and order book pan India is, I think, at the best or the highest levels we've seen in recent times.
Sahil, do you like any real estate or say housing finance stock?
So yes, housing finance, I have a recommendation on GIC Housing Finance that we took under coverage a while. I think that is a stock which has a potential, at least in the next 1 or 2 years we expect it to perform very well. There has been a correction from 600 and it went to sub 500 levels, and I think it's trading at about 545. So once I think you get a level of about 530, 535, it's a great buy. Even in the short term, I think the momentum is picking up. Plus, I think it is one of the cheapest on the street in terms of housing finance companies.
So you would buy at the current market price, or you wait for particular levels to come?
I think you should buy it here. If there is a small dip, you should add to your positions and expect it to move towards 600 plus.
Fairly interesting. Gaurav, I can maybe take a quick 30-second call on one more strategy that you have, and that's a sell call on Hero MotoCorp.
Let's say if you look at Hero Moto, you will see that a lot of short positions were seen getting built from 4,000, 4,050 levels, and they continue to be getting built unabated. So there's a possibility, it's given a breakdown on daily charts as well. So 150 rupee down move from the current levels cannot be ruled out. So with the stop loss of 50 rupees, one can sell Hero Motors for targets of 3,730 to 3,700. That can be seen in 5 to 7 days.
Okay, that's a bunch of strategies. We'll also request our guests to give us one top idea a bit later on in the show. But about 25 seconds left for the pre-open rates to kick in. Let's bring up the rest of the Asian market picture for you. Remember a muted start that we'll get. The SGX Nifty is anyways indicated that we'll probably have a start which is mildly in the red. Maybe it's improved a bit. Let's pull up the SGX Nifty. Yeah, just off from the levels that it was at. But suffice to say that we'll have a bit of a muted start to trade. The question mark is what happens to some of the key newsmakers. There is the Bank Nifty expiry today, and therefore that is something that we'll watch out for as well. Sahil, of course, gave his levels earlier, but this is what the pre-open rates are indicating. So about, well, nothing really. 18 odd points. I think this will be all over the place, but we'll probably have started around these levels. Anywhere between 5 to 25 odd points for the Nifty. The Sensex, anywhere between 50 to 100 odd points or 150 odd points. So not too much on either direction for the key indices. Bring up some key stocks. Bank of Baroda would be top of my list. Let's bring that one up and see if that is reacting at all. There was some sharp movement that we saw yesterday in pharma counters like Dr. Reddy's and Divi's, and those could be interesting ones to watch out for as well. Let's watch out for those. Dr. Reddy's marginally higher, Divi's marginally higher as well. And select names like BPCL, for example, corrected a bit in trade yesterday. Let's see if that correction is still continuing. No, not quite. The rates unchanged for now. So I think once the pre-open rates are settled in, we'll try and revisit these. But yeah, do watch out for BOB, do watch out for NBCC and the newsmakers. Otherwise, Pradeep, seems like it'll be a muted start for the Indian bourses today.
And also some of the heavyweights that have been driving the indices up. You look at Reliance, you look at L&T, you look at HDFC Bank. These have been the drivers. So whether or not they are supporting, RIL was a star performer yesterday. Today again, if you look at it, it's up 0.5%. So RIL at least keeps moving up. Look at L&T and HDFC Bank also from the perspective of Nifty Bank that has been lagging a bit. So L&T is correcting today down by around 1%, and HDFC Bank.
We won't have an 8% of
that's a
HDFC Bank for sure. These are pre-open fun and games. I think these will settle in just moments from now. Okay, we'll wait for the currency as well. But I think the other interesting one is, as we've been talking about, is Dr. Reddy's. I think Sanjeev had a view, Sahil had a view on Dr. Reddy's as well. The greed and fear indicator, the Bloomberg proprietary indicator indicates that could be an upside. But there's a big brokerage call of the morning, and that is from Morgan Stanley, which has upgraded Dr. Reddy's to an overweight rating with a price target of 3,133 rupees. Darshan is there to tell us about the rationale behind the move. Darshan, even if it is a pharma stock and even if it is Morgan Stanley, this is a really big upgrade.
Yeah, it is. And, yesterday we saw CLSA come out with a very bullish note. Today it's Morgan Stanley. And their price target indicates a potential 40% upside to Dr. Reddy's from the current market price. And the key reason that he's saying he believes that the risks are well known now in terms of all the plants that is happening and is discounted in the price because the counter is corrected significantly from the highs. What they're saying is that they are giving a futuristic outlook. They're saying there are 3 or 4 key drugs that will be launched over the next 18 months, and that is something that will drive the earnings for Dr. Reddy's. So they're saying Suboxone, Aloxi, Copaxone, these are some of the key drugs that will be launched over the next few months that will be very detrimental for Dr. Reddy's. They're saying that they see that the high margin sales growth will lead to earning recovery. They have upgraded the EPS estimates, and this is very interesting. The bull case target that they have given is 35.91, which means a potential 60% upside, and the worst case scenario that they have given is 1849, which means a potential 20% downside. So they are rather bullish. So the base case they believe can go up 40%, and a bull case can go up as high as 60%. So I'll keep my eye on Dr. Reddy's today.
Okay, I'm sure all of us will. But just before we go to Sanjeev on Dr. Reddy's, Pradeep, the currency is open at 64.49 versus 64.26. That's a big slip.
So that's a big reaction. Are we kind of betting that, after the Fed announcement, there could be some outflows from debt now, because we have seen so far that debt was net positive so far as the FIs were concerned, while they were selling in equities. So that could be a concern. If you look at dollar also, dollar index, a dollar index moved up to around 92.6 odd levels. So that was a little bit of a bump up. So we are probably reacting to that. And also dollar gained against some Asian currencies like yen. So there could be a reaction in all the currencies. I would believe that this is the rupee is not alone here. All the Asian currencies must be reacting to what is happening in dollar this morning, and that this is, we are just going with the trend. But 64.5, this looks really interesting.
Yeah, it does. Sajeev, any thoughts? Do you track the currency?
Yes, I do, and I thought that the dollar was very heavily oversold, and now you've seen a very strong comeback. We are actually relatively bullish on the dollar, but and as a proxy to that, you would see weakness in metals, which has been the star performer in the last 3-4 months. Weakness in metals, and that would mean a proxy buy that Infosys and Dr. Reddy, like we've been mentioning, will be a good proxy play on both the pharma and the IT side on the rupee side. Another caveat is that along with the strong dollar, you also have oil on the boil, which is actually going to be detrimental for India on the fiscal side. So that would mean additional pressure on the rupee, given that the FI outflows, like your other commentator pointed out, could from equities even spill over into debt.
Voters will probably benefit. That is if rupee keeps drifting down, Sahil. Technically, what do you think?
I think there are two factors at play. About 2-3 months ago, we said that inflation is probably already bottomed out and it's going to move higher, move towards 3.5-4%. So the whole disinflationary phase is already behind. Second thing, there was about a 10 bips slip up on the annual CAD number that we had because of the Q1, because I think about 10 billion was added to deficit only from gold. So although it is transitory, but you have the annual number, which is a little bit of a slip. So I think there is going to be about a rupee and a half of weakness on USD INR. I think it will go closer to 65-50. One of the best ways to play, according to us right now, is to look at textile and ready-made garment stocks, which are net exporters. I think that will be a great play rather than looking at IT and pharma, which are big laggards.
That's interesting. Sanjeev, and that's a valid point as well. For a long time now, within close quarters, exporters have been crying hoarse that things are just not going their way. This is not a trend that we are probably seeing. We don't know whether it will become a trend or no, but are you looking at non-IT, non-pharma exporting companies in any fashion whatsoever?
Yes, correct. You have to be stock specific, because I think a weak rupee will be very good for exports, which has been a laggard. However, like I said, there has been a consensus build up, and the rupee, which was actually a tailwind for most IT and pharma, has now become a headwind. And any leverage they get as the rupee goes towards 65 and above should be a very big added bottom, on their bottom lines. And like we said, not IT withstanding, pharma, we are extremely bullish in the next 1 or 2 years, given that most of the macros are played out, and we still don't have a total outcome on the Obamacare being in the US. So we think it's a win-win for pharma companies. Add to that, like you pointed out, some of the textile stocks. So Arvind is something, and one of our dark horses has been an outperformer called Trident. It's one of the best plays on home furnishing, and it has a huge stake in the paper market also. So Trident on any decline could be an added buy. As a disclosure, we have had the position in this stock. We've been recommended all the way from 40. We've now upped our target to 125 to 130.
Okay, I just want to get in a quick word from Gaurav here on mid-cap IT as well. Yesterday, stocks like NIT Technologies, there was Hinduja Global, not strictly an IT service provider, so to say, but falls within those realms as well. I think they were very, very active. Persistent started moving up a bit as well. Is there a mid-cap IT stock, Gaurav, that you like from a trade perspective?
Well, Analytech, it certainly looks good. It's given a good, strong reversals from 490-500 levels, and with volume participation, a lot of buying is seen in the F&O segment as well. So it can head towards 580-590 kind of levels coming in the next few days. SGS, we also have a recommendation. We have been recommending from lower levels from a technical perspective, from the fundamental perspective as well. So I think 5 to 7% from the current price cannot be ruled out. just because it has moved so much, I think a small dip, 2 or 3% dip in the name can be utilized to build a position for next a month, 1.5, and one can expect 8-10% jump from the current price. Persistent, I would not be that interested, but SGS and Anitech, they're looking quite interesting.
Okay, that's interesting. 9.8. So the pre-open rates have settled. Let's just bring up what the pre-open rates are indicating. I will take in final questions from Sanjeev as well, post that, but just bring in what the pre-open rates seem to be indicating. So you'll probably start off on a flat note, not surprised that at all. The big mover, quite frankly, has been the currency, not so much the equity markets. And again, that was probably expected as well. So that is one. I think watch out for some key names. So Bank of Baroda would be an interesting one to watch out for. Let's see if that has reacted post the clarification that it's essentially not a big bull buying. No, not quite. Bank of Baroda still continues to rise up marginally. I think stocks like NBCC would be interesting ones. And I tell you one stock, Pradeep, that I want to ask Sanjeev Bhasin about. That's Bombay Dyeing. I don't know why this is happening, but the stock has given over 300% returns YTD or in the past 1 year. It's been an interesting mover. I haven't bought anything there, so I can't confess any kind of knowledge about how good or how bad the products are, and whether it's a real estate function at play or something else. But that stock is one name that is really tearing the charts apart.
It would be roughly 150%, I guess, quarter to date if you look at.
Wow.
So it's not only the year to date, but any time frame you just look at, the stock has been moving up. It's a big outperformer actually.
Yeah, Sanjeev, very quickly, any thoughts on Bombay Dyeing?
Well, Bombay Dyeing and Raymond, both of them have been the best plays if you had on the Bombay spiraling landscape. And I think the reality arm and the sell-off of that is keeping, is being a big value accretor. So let's see how fast it goes. But I think there's a huge part of speculative build-up in that. And there was a lot of value given that the land bank itself was almost 50% of the market cap. And we thought that the stock was misplaced. But let's see if anything of those materializes. It will be, it's part speculative, part land bank realizations, which we think in the next 3-4 months you'll see some rhetoric on that being in the positive.
It's just very interesting though what Bombay Dyeing has done in the last 3 months, as Pradeep said, or the last 1 year. 300% gains. But yeah, Sanjeev is right. Raymond too has had some bump up in the last I think 2 odd months post its analyst meet, wherein it was probably at about 720, 730 to about 872. So 3 months about 17 odd percent, which is not bad for Raymond. But pre-open rates have settled. Let's tell you all that you need to know with regards to trade today. The top six things. Brokerages have raised price targets on Tata Steel post its JV with ThyssenKrupp. Consensus indicates that the deal is positive and will help Indian operations.
Well, there are 3 new listings today. Dishman Pharma to relist post its reverse merger with the subsidiary Lhasa Super Generics. And a demerged entity of Onkar Specialty Chemicals will also get listed today. And finally, the new kid on the block is Matrimony.com will list on the exchanges today.
After CLSA, it's Morgan Stanley that has now turned bullish on Dr. Reddy's. The firm has upgraded the stock to overweight from equal weight and high target price to 3,133 rupees, indicating a potential upside of 40%.
Stocks like NBCC, Granules India, Novartis and Amtech Auto will be in focus over various news points today.
Bulk deals have also seen stocks like Om Metals, Bank of Baroda and Magma FinCorp. Expect Om Metals to probably show some reaction today.
And finally, banks will be in focus due to the weekly Bank Nifty expiry. On the other hand, Indocount Industries and India Cements are the new stocks in the F&O band today.
When we talk about real estate plays, the Om Metals is probably a player there too. Again, no comments on whether it is a good stock or a bad stock or whether the land will there. No, but I remember hearing about this Bandra real estate project that Om Metals has, and at some point of time it will monetize. I don't even know if it's already monetized it. But look at that stock, up 12% yesterday. Purinjavali had bought into it, up 17% today. That's trading at 80 rupees. I would presume these are 1 or 2 year highs that we've seen in this stock, or probably multi-year highs. The last 7 days, 40% up move. Either of you track Om Metals? No. Sahil? No. I would guess it will be wrong to ask Sanjeev Bhasin as well about Om Metals. So it's just difficult to
actually,
pinpoint.
if you look at it, every rally over last say 15 years or so, what I've seen that this stock moves up, and then whenever it moves, it's just one-way rally for a while, but it doesn't really last very long. So what are the triggers this time around? We'll keep exploring it, and we'll try and get a view on this stock. But Gaurav, one stock that I should be looking right now is L&T, which is down 2.5%. How do you trade it now?
Well, for positional players, I think it's a good price to buy. There's a strong support seen at 1200. If you look at option chain as well, 1200 put option has a very high concentration. So with a stop loss of 1190, one can buy around 1220, 1225. On the upside, targets can be 1280, 1300. It can be seen in 2 weeks. So it is one stock that is looking quite strong. Any drawdowns can be utilized to build fresh long positions.
Okay. So that's the call for now on this stock. If you look at some of the mid-cap names today, Himachal Futuristic is now quoting down, and we are about to open our regular session in a minute.
Yeah, so just before that, very quickly, your top strategies, 10 seconds. Sahil, your top strategy for the day.
Bharat Forge buy. I think it should head towards the 300 plus or probably make a new 52-week high. So that should be a top strategy for the day.
And Gaurav?
Capital First looks quite robust. One can buy for targets of 860 to 880, and stop loss can be 805.
Okay, so these are the strategies for the day, and we'll see how these stocks really open. But a few seconds to go before the regular session starts. Niraj?
Yeah, so you're all set for the market. 23 odd seconds. Remember, the SGX has indicated, the pre-open rates have indicated that we'll have a flat start to trade. The question mark always is what happens to certain exporters now today by virtue of what the currency has done, and then what happens to individual newsmakers, because frankly the last few days it's not been about the index. Quite frankly, it's been about what the mid caps and small caps and what individual newsmakers are doing. Let's get in the market open here. And we start off on a flat note. So 10,139 for the Nifty, not too different for the Sensex as well. 3 points, it's lying absolutely flat. So is the Bank Nifty too. Actually sub 25,000 now. For the last 2 days, it was actually doing reasonably okay, closing in or around the 25,000 mark. Today is the Bank Nifty expiry, keep that in mind. But no change out there. So lying very, very dormant. I don't think that scene would be too different for the mid caps and the small caps either. So no, a flat start for the mid cap, flat start for the small cap indices as well. Let's pull up the heat map and show you what's happening to individual counters. What's the mood of the market, more importantly. Well, a bit of green on the screen. That's not bad to see. Not too many losers. So we have a few losers, but the top loser is TCS, which is down just about 0.5%. So not too much of a loss really coming in for any of the large names. But look at the winners. Dr. Reddy's, the Morgan Stanley upgrade, Tata Steel about 1% higher, so good going. By and large, it's a stable start with individual newsmakers ruling the roost. Let's get in some indicative rates for 2 or 3 names, and then I toss over to Pradeep for what's really happening. So NBCC, it's backed a new order. That stock is up about a couple of percentage points. Not bad going, 224. And that's a large one, 3,200 crore order that NBCC has received. So that's doing okay for itself. I think Dr. Reddy's could be another one. There are some other mid-caps that are in focus as well. The Morgan Stanley upgrade on Dr. Reddy's leading to this 2.5% uptick on Dr. Reddy's as well, so good going. And Om Metals Infra Projects, that's the other interesting one really. 15% stake, Purinju Veliat, not in his individual capacity, but Equity Intelligence via 2 firms, the AIF and the India Fund, has bought in about 1.6% stake. And after the 12% up move that we saw in trade yesterday, Om Metals has garnered another 17% or a 15% up move. So that's really good going for this one as well. Pradeep?
Den Network is the one we should be watching for. 4.5% up today as it received the NCLT approval for demerger of its subsidiary Skynet Cables, that's into broadband internet. If you also look at Religare Enterprises, this stock has gained 2.5%. KNR Construction is also buzzing, and so is Delta Corp. Delta is up today with good volumes. Also, you have TVS Sri Chakra. So we have been looking at tire stocks. Now today, TVS Sri Chakra moves up with good volumes, somewhere around 2.5% in morning trade. And Bombay Dyeing, by the way, is not hitting circuit this morning. Is up only 1.5%.
What is hitting a circuit is ITDC though, Pradeep. You've spotted that. Yesterday was up about 20%. I think today up about 10%. We'll sell 3 hotels or transfer 3 hotels to respective state governments. That's what the government will do. But ITDC is up and about in the session today. So good going for that one as well. Okay, just before we take in final thoughts from Sanjeev Bhasin, let me just take in initial trading thoughts from both Sahil and Gaurav. Gaurav, to you first. Any thoughts? I mean, markets have started off very, very flat. What would you be doing on any of the other key indices or any of the stocks that you mentioned in the pre-open rates. Would you want to initiate a fresh trade right now?
I think even for indices also, not the Bank Nifty looks robust, only about 25,000, 25,050, but for Nifty one can buy here. As I mentioned, 30-40 point stop loss, 100 point upside from the current levels cannot be ruled out. And Capital First is looking quite interesting, so I would be a buyer in that. I would wait for a small pull down in NBCC, probably around 221, 222, it would be a lovely trade.
Sahil, what do you think?
So I think it's the day has started off with energy, pharma and metals being the outperformers. So I think if it lasts for another 10-15 minutes, I think the day will belong to them. So you probably look at these segments if you want to trade it today. But otherwise, I think Nifty is very, very close to an all-time high. Once it breaks that, there is a real threat that 10,200 might breach. And if that happens, you will get another 50-60 points. So I think Nifty will be a area which you should watch out. Another 20-30 bips if you get a fall of 20-30 points, you should be a buyer.
You would initiate fresh longs on the Nifty 20-30 points.
That's right.
Okay, great. Gaurav Bissa, Sal Kapoor, thank you so much, gentlemen, for joining us today on Indian Open and giving us your thoughts. Well, that's the view on the charts. Sanjeev Bhasin has been with us. And Sanjeev, before we let you go, a couple of thoughts. As we look at the Open, Sanjeev, I think pharma is still making the moves. Divi's is up, I think, a couple of percentage points, if I'm not wrong. Dr. Reddy's has started off well. Your initial thoughts?
Yeah, so like I said, as a disclosure, we've had a sip in them for the last 3 months. We still think there is a lot of value in Sun, Lupin and Dr. Reddy. Dr. Reddy, of course, has been an outperformer. But, try and get into these names. Look at an Infosys closer to 900. It gives you the comfort of valuation and, relative returns. 10% upside in the next 4 to 6 months is on the cards and you will be in a blue chip stock. ITC is another play where we are very bullish at this 270 levels. We were relatively bearish at that 335, 340. We think at 270 there's a lot of value accretion. Given some of parts of their paper, hotels and their FMCG business doing well. So I think pharma, FMCG mixed and IT, some of the heavyweights which we've named could be outperformers. On the mid-cap side, we continue to be very bullish on NBCC and Godrej Property. A dark horse could be Coal India, given that in the e-auctions they're seeing almost a 30% uptick and price realizations in their favor along with volume. So even though it's been a laggard of a stock, given the dividend yield and the change in environment of excess demand for some of the power plants, Coal India for us is a buy with a target of 300 in the next 7 months.
What about Novartis, Sanjeev, with a buyback expected on 25th?
Yes, I think that's a very, very key player because I think Novartis globally has seen a huge amount of traction on the new cancer drug which they've been in partnership with, and that could be a huge value creator. Over here, I think the management sounds very optimistic that it is seeing the stock being languishing, and that's a positive indicator when management start to come and buy their stock back, which puts not only a floor but it also tells you the correct valuation. So yes, that should be a signal to most of the large cap pharma bellwethers that this is where they need to come and stem the rot and put some buybacks or higher dividend plays on the cards again for return of equity and return on for shareholders to go up.
Okay, Sanjeev, really appreciate you taking the time out and joining us today. Thanks much for being with us. That's Sanjeev Bhasin of IIFL with his thoughts. Remember saying that he's comfortable buying into select pharma names like Dr. Reddy's as well. NBCC seemed bullish. And by the way, those are the stocks that are really starting off well. So Dr. Reddy's is now up 3.5% and it's trading at the high point of the day. So is NBCC, 3.5% higher. So really good going for a select band of stocks which have come out with news. Otherwise, the market is lying absolutely flat. On that note, let's get in Ira Dugal, Managing Director at Dalton Capital Advisors, joins us right now in our studios. Mr. Bhatt, thanks so much for taking the time out and joining us. So bullish, bearish, don't tell me neutral.
Well, I think neutral is the way to go.
Really?
With probably a negative bias.
Okay.
Given the sort of problems we have internationally with North Korea flexing its muscles, US flexing its muscles, and even I think the September quarter results are likely to be not very good because of the GST implementation. July was virtually a no sales sort of month for quite a few of the companies, at least not billing. So I think September quarter results will probably be a harbinger for probably worse results. And
you don't think the market is pricing that in? You think the market will start discounting that only once the companies come out with the results?
Well, the market, I think, is conscious of this fact, but nevertheless, I think when it happens, I think the market will probably get to react to that. But I think the December quarter results could probably be the harbinger of better times to come, because especially from a low base, plus also the fact that I think there is some move to give some fillip to the economy, and even that might start playing out by the end of December quarter.
So this morning we have been talking about the global liquidity and what happens to that, if Fed starts shrinking the balance sheet. But the link between us and, US liquidity is actually FIIs. They have been anyways net sellers. So what happens now?
Well, I think the sort of selling that they have done, probably, $500 million to $750 million a month, that is something that can be absorbed by domestic flows as of now, because domestic flows are very, very strong. But if it doubles or triples, thanks to the tightening in the US, I think things can change. But as of now, whatever is the selling by FIIs, I think they are quite well absorbed by the domestic flows.
Okay, so let's talk about individual pockets, Mr. Bhatt. You're talking about how the near term could have some pain, but post the December quarter numbers, we could start looking higher. We just doing that analysis. The 52% of the Nifty weightage, which is the top 10 stocks, which is HDFC, Twins, Reliance, to an extent ITC and some of the others, barring one or two names, don't really show any hints of either weak results or weakness. I mean, Infi and TCS, you could argue they are weak, but they are probably pricing in the negatives. If the markets were to go down lower, and I know when they go down lower, you can always think back and on hindsight think that, things were looking back. But as we look at them right now, what could take the markets lower?
Well, I think it's flows.
The index. Which I understand.
Yeah.
But within the index constituents, what is it that looks weak? What is it that you, if the market starts to unwind, would look to get out of if you do have the positions in the first place?
Well, I think the markets can come down further if there is more aggressive FII flows. And so therefore, the ones where FIIs are having strong weightage, I think that these are the ones that might probably be the first ones to crack.
Okay, let's talk about some of these individually, not specific stocks, I know, but let's talk about banks. What's happening here? For the longest time, PSU versus private debate on, I think we're getting tired of that. But the private banks, despite being expensive, are getting upgraded almost every third day. I've seen at least 4 large brokerages come out and upgrade HDFC Bank in the last few days. Similar is the case with Kotak. ICICI and Axis, which were hitherto left untouched, are also finally now starting to see some interest there. What would you be advising your clients?
Well, I think the most important thing here is that public sector banks, because of lack of capital, lack of resolution of the NPA issues, they are rapidly shedding market share. And these are the banks, the private sector banks, are the ones gaining market share. I think that is a basic story. But the public sector banks are not growing at all.
Yeah, which I agree.
So therefore, if India has to grow at 7-8%, then somebody has to finance this growth, and that is where the private sector banks come in. So they are the ones who are capable of growing at 20% plus growth. So that is why I think there is an upgrade there, and they're able to manage the NPA position also reasonably well. Not that they don't have NPAs, but they have enough profits to provide for it.
So, but which is my question? What happens next? I mean, if the banks are doing all the right things, but they are expensive, what would you tell some of your top clients, or if you are investing money, would you choose the private sector banks even at these levels?
See, at these levels, it is very difficult to find big buys in the market. So therefore, you hide into those where the growth momentum can be quite strong. And that's where the private sector banks come in, despite being reasonably expensive based on historical valuation benchmarks. But I think the growth momentum there is really very strong. And that's why I think people are buying into this.
So you hold on to private sector banks and also NBFCs, the home finance, brokerages, and whole host of NBFCs that have moved up.
Well, I think that's the only game in town now. So therefore, I think one should hold on to these because they are the ones who are probably least vulnerable to a potential sell-off.
So the other story that big players have probably played so far is the domestic consumption, auto being prominent. Look at Eicher or Maruti. What's your view there?
Absolutely. I mean, even during the slowdown, if you really see, this is the only sector which showed some growth. And now there is some robust growth there. So therefore, I think this is one sector which will continue to be favored by most investors because even though the valuation argument fails across the spectrum. I don't think anything is cheap in this market. But among them, these are the ones that at least there is some justification for the valuation.
Okay. Now, Mr. Bhatt, a couple of other pockets. The long spoken about consumption story, very well discounted, most people know, but if you look at what's happening at the broader end of the spectrum, and I was making this point earlier today, that while we like to look at what the Nifty levels are, the mid caps and the small caps are trading at astronomically high valuations at higher levels, and almost every single day it's a story of not of what's happening in the index, but what's happening at the broader end of the spectrum. What happens to the consumption names in the wide market?
Well, I don't think one can say this about all consumption stocks, but at least the top few of them, they have been able to negotiate this slowdown quite well. They are still showing growth both in volumes and price. Right. So therefore, they are the ones that are favored by most investors. But I think the same thing cannot be said of the rest of the pack there. They are probably at unsustainable valuations, and I think they are the ones probably most vulnerable to a sell-off.
It's a large basket, Mr. Bhatt. Yeah. So let's try and narrow it down. I mean, I'm in consumption, I'm including what the home consumption space is as well. So the home upgradation space, so the ceramic tiles, paints, etc., all of them come into play as well. You could probably even look at financiers of some of these consumption names as well. So the Bajaj Finance, etc., come into play. What within this basket, non-Nifty 100 maybe, do you find really expensive?
Well, I think one can't really talk of across the board stuff, but I think specific companies there you will find that they're very expensive, unsustainable. Potential sell-off can be quite disastrous there.
Okay. Well, moving back to another sector, which is metal. If you look at the performance, it has been really startling. You look at steel or base metal. Now that we see, if you look at the cues from commodity markets, there is kind of a topping out. There is not so positive news from China. What's your take there? Will you stay on?
Well, I think, for want of better places to hide, I think this is one sector which has done reasonably all right, and there are no great indications that there is a huge potential sell-off there. There is the growth momentum in the US, growth momentum in Europe, everywhere the growth momentum seems to be there. So therefore, one can sort of hold, but at the same time keep watching this space very closely for a potential exit.
So this is because it's overall a macro story. So you are bullish on global growth and therefore bullish.
Therefore, I think it's worth making that whole position continuing.
And what about some of the other exporting companies from India? Would you be bullish on that? Any sector you like?
Considering what the currency has done today.
Well, I think that's somewhat difficult because the biggest exporters are IT companies. IT companies, I think, at best you can be neutral because they are having a tough time. There is a change in the complete the business fundamentals there. So therefore, as I'm fond of saying, yesterday's winners may not be tomorrow's winners. So therefore, one has to really keep a close watch as to the ones who can negotiate this change very well.
I wish I could ask you which of yesterday's winners could be tomorrow's winners, Mr. Bhatt, because that's the $1 million question. Otherwise, all of these things seem to be discounted. But, just before we wind up, maybe a couple of questions. We're getting some viewer queries, Mr. Bhatt, some of them specifically for you. So, Nipun Kalra, there's a gentleman who's written to us, and he's asking whether you foresee a correction in Indian markets since liquidity also has some limits. I know you started off the discussion with a reference to this, but could you elaborate a bit on this?
Well, see, liquidity, as I said, that about $500 million, $750 million of selling by FIs can be absorbed today because of the huge domestic inflows. But consequent to what is happening in the US yesterday, what happened in the US, and there is some unwinding of the quantitative easing. There is always a big problem what is happening in North Korea. So any of these things can take liquidity away quite dramatically, at least the flows, and so therefore the selling by FIs can increase quite dramatically. So that is the one event I think one has to keep a watch over, because it is not as if domestic flows are going to increase dramatically from here. Because I think we are having a good time as far as domestic inflows are concerned. So there is a limit up to which domestic inflows can't keep the market high. But if the FII outflows continue, in a more robust fashion than what it is now.
Do you think they can do more than $2.5 billion in a month, which they've already done in the month of August? FII outflows.
Yeah, it is. That is about the limit. I'm taking the average for the last, say, year to date. Average is probably about between $500 and $750 million. Right. So that sort of absorption is possible. But August was particularly good because there's good news about GST not being as disruptive as people thought. But I think the September quarter result might be a very important sort of time to watch, because that would the July problem will probably show up in the September quarter results. And that's when I think there could be a market correction. And we don't know how this North Korean episode is going to play out. If they come to the negotiative table, I think they could.
So North Korea is a black swan, Mr. But my last question to you, I don't know, maybe Pradeep has one more, but my quick last question to you. I know you're not a technical trader, but what are the levels? What kind of downside do you anticipate? Let's assume North Korea doesn't happen. Normal FI outflow happens because of what the Fed has done and otherwise. What kind of downside?
Not too much, I think, because domestic flows can keep the market at around these levels. I think, at best 10,000 may be reached marginally, not dramatically lower than that.
So since you talk about domestic flows, all the viewers watching us, they have probably, many of them have started fresh SIPs. What's your view on that? I mean, is this really a good time to keep, investing in mutual funds?
SIPs are the only way to go, because SIP is the best one when you have such high levels of uncertainties in the market. You should keep continuing the SIPs. Never stop SIPs, because whether it's good or bad, I think SIPs will make you money in the long run.
Wow. And we'll talk about the SIPs a bit later on the show as well, when Milind Barve of HDFC Mutual Fund joins us today later on. But for now, Mr. Bhatt, thank you so much for taking the time out and joining us today. Really good to have you.
Thank you.
We slip into a short break at this point of time, but up next, A.M. Nayak of Larsen & Toubro joins in to speak about his expectations of how the investment climate is likely to remain subdued. We also talk about private insurance industry with Arijit Basu of SBI Life, and Filippo Gori joins us to tell us what JP Morgan is betting on. Hi, today's a historic day for BloombergQuint. We've launched our digital live streaming business news service today with this very first show, Indian Open. Welcome back. And let's now get to the big corporate voice of the day on the show. A.M. Nayak is all set to give up his executive position at L&T this month. He will continue as global non-executive or group non-executive chairman at L&T. Now, the man who rose from being a junior engineer to the corner office at one of the country's largest capital goods and engineering companies spoke to me about a whole host of issues, including his life at L&T and India's investment climate. That's what we're going to focus on for the next 10 minutes. I started off by asking him about his assessment of the Indian economy. Listen in.
Whenever the major change is made in the configuration of how the economy is built, like the
Are you referring to demonetization, sir?
No, not demonetization alone, but yes, one is demonetization.
And GST.
And GST. Both of these are earth-shaking changes, major changes. So it created a lot of stoppage of activities. Even now, we are finally still not out of GST. I can tell you there are still customers who are not taking the equipment because they said whether it is 18%, they are fighting out to maybe less than 18, and a lot of inventory has piled up, and not sales are not occurring. If these two were not there, I think the economy would have been 7% instead of 5.7.
Right.
But at the same time, somebody has to take the bull by the horn and look at long-term future.
So you believe, GST, of course, there's no debate. We all expected that it is a necessary change and it will have a period of settlement, it'll take some time to settle in. The jury is still out on whether demonetization was a good thing or a bad thing. You believe that it was the right thing for the economy?
Well, long term, if really demonetization is implemented properly, and the amount of cash purchase which was taking place, if that is cut off, I think long term it will produce more tax because all the transactions are above board. And I think 1 year I give for demonetization impact to become more positive.
Okay. You believe that things will slow down even further here on, so things will get worse before they get better? Is that your assessment of the economy right now?
I am assessing that things are not going to be better, may remain stagnant, steady.
For how long?
Maximum 9 months. 6 to
9 more months.
9 more months.
9 more months.
9 more.
You know, in February when I spoke with you, Mr. Naik, you told me then that in your estimation, we were talking about the logjam in infrastructure, right? So many projects that were stalled and the lack of the right kind of contract.
Demonetization had not happened then.
No, it had happened in November, but the impact was yet still uncertain, as you pointed out. In February, you told me that private sector will take 2 to 3 years to return to infrastructure. You said that infrastructure had been through such a terrible time.
You can
that
see
2
it
to 3.
is
Do you now think, given the impact of demon, given the impact of GST, that in fact the private sector will take even longer to return to infrastructure?
I would say 2 years, no. 2 years they will not return.
You don't
As
expect
a
any
private
large, so just to
sector-
explain this to viewers, you don't expect any large infrastructure projects to be undertaken by the private sector in the next 2 years at
Except
least.
for 1 or 2 industrial houses.
There is now this debate in the country that if economic growth continues to be slow for the next few quarters, should the government consider some sort of fiscal stimulus? This is at very nascent stages. There's almost always been for the last several months the debate that the RBI should cut rates faster. In your assessment, will a fiscal stimulus and or lower interest rates help resolve the problem that is plaguing infrastructure in India?
I think very limited extent, because the interest rates have come down already to 6%, and bringing down another 0.5% or 1% is not going to be a great stimulus. Okay. The real reason is that those who went into infrastructure development and many other mega projects in 2004-5, and they had a tremendous amount of debt. I mean, running into some companies 40,000, 50,000, 80,000, 100,000, have not been able to fully pay the debt back. Consequently, there are many non-performing assets, lot of NPAs, and there may be more and more NPA if this outstanding amount is not paid. So for private sector to come out of all these difficulties itself is going to take 2 years. And there is 6.5 lakh crore is something which is today not used for productive purpose. And the private sector has no capacity to pay back.
6.5 lakh crore worth of projects.
Yeah, not project, but that is the amount.
Capacity. Yeah, capacity of projects, right? Yeah.
So I think before the private sector can take on, they have to clean their past.
And that you're saying will take at least 2 years?
At least.
At least 2 years. So in that period of time, where do you hope to get your growth from? You have said at the beginning of this financial year, which is FY18, you expect about a 12 to 14% increase in your order book. Do you feel now that we're coming to the end of the second quarter that you want to maintain that outlook on the order book? You've had some softness.
We had said 10 to 12 and we will remain 10 to 12.
12 to 14 is what you had said, sir.
Well, my impression is 10 to 12, but you may know better.
On the order book?
Order book, yeah.
Okay, my impression was 12 to 14, unless I'm confusing it with the revenue outlook, but I thought it was 12 to 14 in terms of your order book outlook. You're saying that will it be 12 to 14 or maybe lower than that?
I said 10 to 12, call it 12. Then we are both faced. Okay.
Where will it come from? Fair enough, because I know, we've discussed this before.
I'll tell you.
Okay, why don't you answer the question, then I'll ask my second question on this.
Okay, number one, while we have come out of many businesses, I said 5.
Yeah.
We have created one major vertical, and we have appointed an executive director in charge of that about 4 or 5 months ago. That's a major organizational structural change.
What vertically you refer?
Mr. Patil is now made a executive director in charge, seeing what the defense prospects are all about. And we think that in the next 6 to 8 months, we have a chance from zero last year, because the defense has started this year, about 20 to 25,000 crore prospect, and maybe we may.
So in FY18, you expect 20 to 25,000 crore worth orders from the defense sector.
That's the potential, yes.
That's the potential for L&T, or that's the potential
for L&T.
That's the potential for L&T.
Right.
What percentage of orders, or what is the quantum of orders right now from defense, sir?
About 8,000 crores.
So you hope to be able to treble this at this point in time?
It's not a question of triple. One tender you win, that tender is of 25,000 crores.
The other two quick questions is, I think, how's the hydrocarbon business been doing? Because that's been a sticky one for you over the last few years. Are you finally seeing much recovery there? And secondly was about your international markets. Your international orders have been dominated by the Middle East. We've seen, again, thanks to lower crude prices, that being a sticky spot. You said you were expanding to other markets, including in North Africa, etc. So what's the outlook on the international markets front and on the hydrocarbons front, if you could give us a meaningful update?
I think hydrocarbon, we have come out of all the problems as we had before,
so you're
where we lost a lot
of
money. And we think that there is a sea change now as we came out of all the old projects and we have got into new projects. Our target for 16,000 crore this year of order book, I think we have a possibility to meet that. We are L1 in 2 of the project in Middle East. We'll get both of them. They are worth about 3,500 crore. And we think, again, something which is estimate, from minus few hundred crore per year, we are going to come this year to plus few hundred crore. So I think, I can't tell you exact, but it will be a sea change in the performance in hydrocarbons. So that is moving for better. As far as the Middle East is concerned, obviously it is down. And while it is down, there are some very important infrastructure projects.
Like in Qatar, etc. that you're like the ones in Qatar, etc. that you're working on.
Well, one is Qatar, there is one major one in Abu Dhabi, which is $2 billion, 12,000 crores. We have bid with a local company. I'm told that we are well placed. But, you know, finally it is a politics there as well. We don't have that deep a contact there as many people who can fly and meet the sheikh, and obviously we don't have in L&T anyone who can
Don't say anything more, you'll lose the contract. Don't say anything more.
But if we win such kind of 1 or 2 jobs, we'll be okay.
Okay. And there was one more aspect of the business that I wanted to ask you about, and that is that you all have made, and this is again something you had pointed out to me over successive interviews, that while things were tough in the last 2 years were tough, that you were working on making sure all operational efficiencies were kicking in. So for instance, when it came to working capital parameters and things like that, there has been quite a bit of improvement that has been made.
The margin has gone up by 0.5%.
I know. There has been quite a bit of improvement made. What is the scope for further improvement?
No, at the moment, I think we should keep ourselves at a level we are, because the market is tough, as you told, as you mentioned yourself.
Was tough. Now you're sounding good, happy about it. And
I'm happy. I mean, sounding happy, but we got to finally be happy.
Okay.
And our cost-cutting program continues, and we are still hoping that we will improve our margin by 0.5%.
0.5% more from here.
Yeah.
Okay.
By end of the year.
All right, that's AM Naik telling you that he doesn't think the economy is going to recover at least for another 9 months or so. And by recover, I mean he isn't seeing any substantial growth coming in for the next 9 months. He said he doesn't expect the private sector to return to infrastructure for at least another 2 years. But he did sound optimistic about some big orders that they were hoping to bag in Mumbai around the infrastructure that's being built in the city, some international orders. And he also sounded constructive about being able to make improvements in working capital and on the margin front at L&T. This is his last month as Group Executive Chairman. Next month onwards, he will be just Group Chairman. And you can get more on that interview if you visit www.BloombergQuint.com. That top story will be on our page in just a few seconds from now. More details on L&T AM Naik coming up on our website.
Well, from corporates to markets back again, and he interacts with some of the wealthiest investors in the world. Filippo Gori, the sales and marketing head of JP Morgan Asia Pacific region, who is right now in India for the JP Morgan Investor Summit, joins us on the sidelines of the summit from New Delhi. Filippo, thanks for joining us on BloombergQuint. Now, emerging markets, equities have outperformed developed markets this year. What have you made of the rally, which has mainly been driven by liquidity, I might add domestic liquidity? Do you see more legs to this rally?
I think there is an element, of course, of liquidity, of the ample liquidity that is available in the markets globally that is driving part of the rally. I think, though, or we think, and investors seem to have put a premium onto owning EM shares compared to the relevant development market shares, also because of the various higher EPS revisions that we have had over the course of the year. And if you think about the year in itself, has had a variety of different fields, starting from maybe the technology rally led that you had in China at some point, and some of the other things that have happened during the course of the past 9 months. My view is liquidity is a driver, and as such, some of the headwinds could be coming towards EM when part of this liquidity will be removed.
Filippo, you also track the Asian region pretty closely. Which are the markets here that your clients are most bullish on? So, from an equity standpoint, there's definitely been a lot of interest this year in Korea, China, and India. From a fixed income standpoint, it has been a little bit more of a muted year so far, although India is definitely one of the areas that has been of interest for the global investors. But on the equity side, I would say Korea, China, and India. Filippo, Indian markets have been supported by domestic investors. Why do you think FI flows in India are missing?
So, first of all, it's a bit of a subtlety, but I don't think that the foreign investors haven't come to India. I mean, from our estimate, we think that foreign investors inflows into India have been around 7 billion year to date, and by the end of the year, they should be higher than the whole of 2016 and 2015 equivalent. So, the foreign investors have been coming into India. The one point is, though, that foreign investors have been running an overweight on Indian shares now for a decade. And in this sense, if this year India is performing, the Indian equities market is performing more in line with the broader emerging market index, it could be that this is proving not to be enough of an impetus to add further to an overweight that has already been there for a long time.
Filippo, what's your take on the recent geopolitical worries arising out of North Korea? Are the markets reading too much into it, or have they digested these pressures?
So, of course, we are all hoping that the situation improves and that the negotiation will solve the current impasse. From a personal standpoint, I think the major concern I have is that there could be an accident, an involuntary accident that could precipitate the situation. From an overall investor sentiment, investors seem to be relatively calm about it. I was in various countries in the region, traveling across various countries in the regions, and investors seem to be relatively calm and relaxed about it. A few of them have gone back into cash or have added a proportion of cash to their investments, but there is no panic out there.
Filippo, disruptive technology is reshaping trading business. What are the trends in Asia, and what are the implications to your business?
So Asia, in terms of fintech, I think Asia is driving the agenda quite substantially in terms of a lot of innovation that is coming through in the marketplace and in technology in general. As a firm, we are embracing all this new technology, in part because of that disruptive behavior which we want to be at the forefront of, but also in part because we believe it will help us serve our clients better. And in that sense, Asia is currently, for JP Morgan, is currently testing some new technology that we are using both on the trading and sales side of the business with the idea of helping us delivering better solutions to our clients. It is definitely a fascinating time for us to be part of this region, and it's super interesting.
Lastly, which Asian market as a house is JP Morgan most bullish on?
Definitely India, for us, is one of our most important countries and markets. It's a country where we are super optimistic about the future. The reason why we have the conference here is a testimony, and Jamie Dimon coming is a testimony of the fact that we are heavily invested in the countries. We have recently opened some new branches, and we believe that India is one of the key markets for us where we can grow further.
Very much appreciate you joining us today on the sidelines of your summit. Thanks for taking the time out and speaking with us on BloombergQuint. And remember, we'll have a whole host of other voices from the JP Morgan Investor Summit all through the day today. So do stay tuned to BloombergQuint.
All right, also stay tuned to catch all the big voices coming in from the Bloomberg Global Business Forum that has been underway since yesterday. We've got for you Bill Gates, Tim Cook, Anand Mahindra, Arundhati Bhattacharya and Michael Bloomberg, and all of them will be playing out on BQ Live all through the day today. That's the Bloomberg Global Business Forum underway since yesterday.
All right, now before we wrap this edition of Indian Open, a quick conversation with the big IPO that is in the market. Arijit Basu, head of SBI Life Insurance, is joining us with a quick conversation here on the network. SBI Life, as you know, opened on Wednesday. The issue is open till Friday. It's a large size insurance issue after ICICI Prudential, of course, the big life insurance issue in the market. There are a bunch of general insurance issues coming in as well. We've been talking about SBI Life for a while. I think analysts are generally fairly impressed with the fact that the company has a strong market share position, strong growth. But there's one factor which is a little bit of a risk factor which is worth talking about, and we're hoping to get Mr. Basu to speak on that, is the proportion of ULIPs. And ULIPs are unit-linked insurance plans, so in some ways more of an investment product than an insurance product. The proportion of that in SBI's new business premium is fairly high, and some analysts have questioned whether that can be that can prove to be a risk later down in the line. Just to explain why it could potentially be a risk, the reason being that because these are investment products, they tend to be a little bit more volatile. So hypothetically, if there were to be some sort of volatility in the market, you could see this ULIP portfolio getting disrupted. The other question to ask, at a more fundamental level, is why a life insurance company, and this is not specific to SBI Life, let's be very clear about that, but why some of these life insurance companies are not being able to grow the pure protection portfolio as rapidly as some of these
exactly what we were discussing yesterday with Hemendra Hazaria. I think if anybody had tuned in to our live conversation, Hemendra pointed out that these are more mutual fund companies than insurance companies.
Mr. Basu is there. Let me put that question straight to him. Mr. Basu, thanks for joining us. I know you had to rush in to make it here on time. But, sir, I think the question, and it's a valid question, you're not taking away from the strength of SBI Life at all. But what's the story behind the high proportion of ULIPs, particularly as a proportion of your new business premium, sir?
Just to understand how an insurance product is structured, I think it will be appreciated that every insurance product, whether it is a ULIP or on the traditional platform, does have a core protection element. So, as you know, to get even a tax benefit, you have to have at least 10 times sum assured as a proportion of your premium. So, the sum assured has to be at least 10 times your premium. Now, having said that, there are two parts to the discussion that I was following. One part relates to why pure protection, that is a product where you only offer a sum assured and there is no other benefit at all, why that is not so popular. among all companies and in India. And the second part of the question related to whether why ULIPs have picked up. So first, coming to as to why protection is perhaps not understood, you must appreciate that financial understanding in India is still very nascent. Our equity markets also are not that developed. We have one of the lowest ratios. So it all depends on the understanding of an individual. And in a protection product, what happens is, as you know, the premiums are low because the entire cover is reserved for mortality. And the individual does not get back anything. But it does protect his family and his near and dear ones. That understanding that you may not get back anything at the end of the term is something that is not very well appreciated even now, which is why pure protection tends to be low. However, it's for us it's at around 5%, some companies even have.
May I just interrupt you for a minute, Mr. Basu, because I understand those dynamics, yes. But private insurers have been out there in the market for a while. I just wonder if it's the easy route out to push ULIPs over pure protection, which would definitely be a harder sell.
I was coming to that. So first I was answering the discussion as to why pure protection has not picked up in India, and it's not private or public sector. There's only one public sector. For them, the protection sales are even lower as a proportion to their total sales. So, and even in Western countries where you would perhaps, going by this logic, expect 100% protection, that's not the case. Even for our joint venture partner in France, it is significantly higher than us, but it is somewhere between 25 and 30% pure protection product. Even for them, savings products are about 70 to 75%. So that is one part of the debate. The second part of the debate is why ULIPs have picked up. Now, if you look at the platform, and once you decide that savings is one component that you want to give back to the consumer, you can either do it on the market link platform. Remember that you have to first you have to assure 10 times protection for a ULIP buyer as well. And then you need to do it either on the market link platform, or you can do it on the traditional participating 90-10 platform. Now what we are seeing is that those who are financially more aware, and they are looking at the prospect of higher return in the market linked savings product and are demanding that. And what we also find is that because their ability to take greater risk is higher, the premiums tend to be much higher in ULIPs. That is, the size of the cover is also higher, the returns are also higher.
Sorry, sir,
so for us, an average ticket size in ULIP.
So that's the problem, that a lot of people are still seeing this as an investment product. And to me, I mean, are you saying that 70% of new business premium coming from ULIPs is par for course across the industry, and you wouldn't be worried about it, sir? Because it does make you a little bit, sort of more exposed to volatility in the market, probably more than an insurance player should be.
So I think, again, two things. If you were to delve deeper into this, all I am saying is that first, this cannot be equated to a pure mutual fund product because it offers a 10 times cover as over what is being offered. That is not there in a mutual fund. So you have a 10 times cover in a ULIP product, which is not there in a mutual fund. The second thing is that for us, for example, so the ULIPs that we have, 48,000 crore is our total ULIP asset under management. And the funds underlying the ULIPs, it could be a debt fund or it could be an equity fund. The funds underlying the ULIPs are left to the choice of the consumer. Just for information, for us, 29,000 crores is in debt and only 19,000 crores is in equity. So the customers who have come into SBI Life, even in this situation where the markets are doing very well, have chosen debt. So to some extent, we must leave it to the consumer. Second point is, if you look at the number of policies, which is the point I was making, even today the number of traditional policies we are selling are significantly higher than the ULIP policies. It is only because the ULIP ticket size is higher. Our average ticket size in traditional is 30,000 and ULIP is 70,000. That this difference comes in. Yes. Okay, sir. Sorry, we've run out of time because we got you on a little bit late. I apologize. We can't get into the other aspects, but like I said, analysts are very enthused by some of the other aspects of the IPO. This was one risk factor which we really wanted to debate and discuss with you. Thanks for joining us here on Indian Open today.
All right. So historic open, historic close. With that, we wrap up this edition of Indian Open. But stay tuned to BQ Live, because up next we've got for you, for the first time, an F&O dedicated show. And we've got 3 F&O experts passionate about the space to talk you through what to expect in trade today. That's coming up next.